Picture this, right? Warm sunshine, endless beaches, the whole Florida lifestyle. It is a dream for so many of us. But let's be totally honest here. Right after that beautiful daydream comes this sudden cold splash of financial anxiety. Like, can you actually afford it? Or are you about to step into a 30-year financial trap? Well, welcome to today's Explainer, where we're going to take that massive, intimidating question and break it down into something you can completely control. Making your way to owning a home in the Sunshine State can seem incredibly hard, but it's actually entirely manageable if you have the right tool in your belt. Today, we're diving into the Florida homebuyer's secret weapon, the Florida Mortgage Calculator. We're going to see exactly why flying blind into a 30-year financial commitment is literally one of the most dangerous things you can do. Honestly, running these numbers before you ever step foot in a bank or open a real estate app is absolutely crucial. It's the most important step of your entire journey. So here's our quick roadmap for today's Explainer. 1. Dreaming of Florida homes. 2. The Mortgage Calculator explained. 3. Why you need to calculate before buying. 4. Navigating your mortgage options. And 5. Avoiding common costly mistakes. Let's get right to it. I want to ground everything we talk about today in this single, really powerful idea from our sources. Financial peace of mind comes from knowing exactly what you can afford before you sign the closing documents. Notice I said before, not after you fall in love with a kitchen island, not while you're sitting across from a lender who's just telling you what you quote-unquote qualify for, but before. You absolutely have to be in the driver's seat of your financial future. All right, kicking things off with sections 1 and 2, Dreaming of Florida Homes and the Mortgage Calculator explained. Let's see how we take that sunny Florida dream and actually ground it in reality. Okay, so let's break down this whole illusion of the monthly payment. When most people think of a mortgage, they probably just think of paying back the loan amount, the principal. But your monthly payment is actually a bundle, an acronym called PITI, principal, interest, taxes, and insurance. And in Florida, oh boy, property taxes vary widely by county, and homeowners insurance is just a massive factor because of the weather. Relying only on the principal and interest will completely wreck your budget. A good calculator forces you to see the entire pie, not just the slice you want to eat. Before you even start house hunting, you need to establish a baseline using what's basically the golden rule of home buying. It's called the 28-36 rule. This rule says that your housing costs, that entire PITI pie we just talked about, should be no more than 28% of your gross monthly income. And on top of that, your total debt payments, including things like car loans and credit cards, need to stay under 36%. By just plugging your income into a mortgage calculator, you instantly see if that dream home keeps you safely in those margins or if it's going to push you into serious financial strain down the road. Moving right along to section 3, why calculate before buying? Why is there such a huge urgency to do this before you even start looking? I really want you to let these numbers sink in, because this is where the calculator totally proves its worth. Say you're running different scenarios for a standard loan. A 15-year term at 6.5% gives you a higher monthly payment of $2,190. But get this, your total interest paid is $194,200. Now stretch that out to a 30-year term at the exact same rate. Your monthly payment drops to $1,580, which feels great for the monthly budget, right? But your total interest balloons to over $368,000. That's almost double. And what if that 30-year rate bumps up just 0.5% to 7%? You're paying nearly $400,000 in pure interest. Seeing these numbers for yourself before you talk to a bank means you aren't just accepting whatever term they push. You're actually making a strategic choice about hundreds of thousands of dollars. All right, section 4, navigating your mortgage options. The calculator isn't just a truth teller. It's basically a sandbox where you can safely play with different scenarios to protect your hard-earned money. When you start putting your data in, you have to choose a loan type. A fixed-rate mortgage is exactly what it sounds like. It's predictable, it's steady, and it locks in your interest rate for a full 30 years. It is the ultimate tool for long-term budget stability. But on the flip side, an adjustable rate mortgage or an ARM gives you this tantalizingly low initial rate, but it will change with the market. If you use your calculator to model an ARM, you literally must run the worst-case scenario. If rates spike in 5 years, is that new monthly payment going to break your 28-36 rule? The calculator lets you test that stress before it becomes your actual reality. You also have government-backed alternatives, and these are incredibly popular down in Florida. FHA loans are fantastic for first-time buyers because they require a much lower down payment. VA loans are an amazing benefit for our veterans and active-duty military, often needing zero down. Zero. But here's the catch. These loans come with very specific insurance premiums and funding fees. A quick back-of-the-napkin math equation is going to miss these entirely. A proper Florida mortgage calculator lets you plug in those exact fees so you get a totally transparent picture of your real monthly obligation. I absolutely love this insight from the source material. It says, the most powerful tool in your financial arsenal is the ability to visualize the impact of your choices before you commit to them. It's basically time travel for your bank account. You get to see the exact consequences of your financial decisions decades before you actually have to live through them. To put that into perspective, just think about how powerful it is when we use the calculator to customize our payments. Say your standard 30-year payment is $2,000 a month. By running the numbers, you might discover that if you just add $100 extra a month, literally just skipping one nice dinner out, you shave 3 entire years off your loan, dropping it to 27 years, and you save $34,000 in interest. And if you can manage an extra $300 a month, you pay off your house in 23 years, saving a staggering $84,000 in total interest. I mean, this isn't magic, it's just math, but you'd never know it was possible if you didn't use the calculator to test it out first. Which brings us to Section 5, avoiding common costly mistakes. Basically, what actually happens if you don't prepare? 2 to 5%. That is the chunk of your total loan amount that's going to go straight toward closing costs. And this is honestly one of the biggest shocks for new home buyers. They save up their exact down payment, they get approved, and then, bam, they get hit with thousands of dollars in closing fees they never even saw coming. A really great mortgage calculator will have a specific field to help you estimate these costs, forcing you to realize that, yeah, you need serious upfront cash beyond just the down payment to actually close the deal. Another major trap to watch out for is PMI, or private mortgage insurance. If your down payment is under 20% of the home's value, the lender is going to charge you an annual fee of between 0.46 and 1.5% of your loan. And what is this for? Just to insure themselves against you defaulting. It gets rolled directly into your monthly payment. By using a calculator early on, you can toggle your down payment amount. You might find out that waiting just 3 more months to save up a slightly larger down payment completely eliminates that PMI, bring up hundreds of dollars in your monthly budget. So here's a quick checklist of mistakes you absolutely must avoid. We talked about hidden closing fees, but you also cannot ignore local property taxes. Florida's vast, you guys. The tax rate in Miami is not the tax rate in Gainesville, for example. Alachua County has a property tax rate around 1.06%. If you just plug a generic national average into your calculator, your monthly estimate is going to be wildly inaccurate. Actually, scratch that. It could totally ruin your budget. Finally, don't just use the lowest advertised interest rate you see on some billboard. Your actual rate depends heavily on your credit score. If your credit is average, but you calculate based on a perfect credit interest rate, you are setting yourself up for a very painful reality check when the lender finally runs your file. Okay, so let's get into the actual game plan. Here is your actionable, step-by-step method for using a Florida mortgage calculator starting today. Step 1, input the total home price and your realistic down payment. Step 2, select an interest rate that reflects your actual credit score and current market trends, not just a best-case scenario. Step 3, toggle between a 15-year and a 30-year term to see what fits your long-term goals. And Step 4, honestly, this is my absolute favorite tip from the sources, compare that final estimated monthly payment to your current rent. If the mortgage is, say, $500 more than your rent, take that $500 and put it in savings every single month for 3 months. Test drive the payment. If it feels too tight, you instantly know you need to adjust your budget before you're legally bound to it. Buying a home in Florida is a massive milestone. It's exciting, but it should never, ever be a leap of faith. It really needs to be a calculated, strategic decision. These calculators are completely free, they're available online, and they take all the mystery out of the whole process. We've seen how this one simple tool can show you the stark reality of your monthly payments, help you save tens of thousands in interest, and protect you from nasty hidden fees. The information is out there waiting for you. So the only question left to answer is this: will you run the numbers before signing away your future?